Hello, my name is Charlie Buxton and I'm the Head of Investment Consulting International, based out of our Hong Kong office. I'm responsible for working with financial planners and their clients in communicating our investment process, how we manage money, as well as being a member of various investment committees. Today, I'm going to talk to you about the dangers in trying to time the market. Over the last 4 years particularly, we've witnessed some sharp movements in stock markets, both up and down, from COVID in 2020 through to Russia's invasion of Ukraine in 2022, a regional banking crisis in the US in 2023, and of course a flurry of market-moving data reads throughout. On all fronts, you'd be forgiven for trying to take a view on the exact timing of investment, whether to sit in cash awaiting redeployment into the stock market, or, and arguably most costly of all, selling out of investments upon seeing a significant drawdown in the stock market. The dangers of trying to time markets are well illustrated in this first graphic, showing the performance of US markets over the last 32 years, from 1990 through to 2022. You can clearly see that over this period, remaining invested in the market would have led you to a 9.75% annualized return, compared to, for example, just over 8% if you had missed the 5 best single days in a year. In monetary terms, this equates to missing out on $7,941 worth of returns over that period. It of course only gets worse the more positive days in the market that you miss. In times of market turmoil, acting on emotion runs the very high risk of missing these best days. It ignores the fact that news flow, which has often triggered such panic, is already incorporated into the price. Markets are forward-looking, and this is particularly the case given that the best and worst days tend to cluster together, with a 10% fall, for example, often followed by a bounce back of a similar size. Part of the problem is not knowing when these positive days will come, which is impossible to judge given the various and numerous factors that dictate the direction of markets, and particularly where bad news economically can often be interpreted as good news for markets. Furthermore, as the next chart shows, negative intra-year returns often do not result in an overall negative year, 2002 and 2008 being the only such exceptions. To illustrate this with some real-life events, if we think back to some of the more historical market-moving catalysts, which initially resulted in some negative returns, over the longer term, performance rebounded strongly. Over 1, 3 and 5 years, we can see that for a 60-40 portfolio, i.e. 60% in equities, 40% in bonds, there has never been a period where after 5 years, the portfolio hasn't gone on to make strong gains. Over 3 years, this is also the case, except for the dot-com bubble bursting back in 2000. When we put all of this together, we can clearly see just how damaging trying to time the markets can be, and how important it is, therefore, to keep emotions in check and to remain invested over the longer term. Ultimately, none of us can predict when or how strongly positive days in markets will come, but the effects of being out of the market are clear for all to see.